basic math. It's an 8. And you subtract 5, which puts you at negative 0.2. All right, so if we get something higher, 0.8 or higher or plus, or we get negative 2 or more negative, we can expect the market to react by at least 50 points. And the way to react is, at this point, if we see a number that is higher, that normally means the economy actually is doing better, and the unemployment numbers, although they reflected not the same amount of growth that we were looking for, it still would create a selling in the yen. So again, a 0.8 or higher, we would see the yens do this. So again, they would be sold off. Like I said, if core retail numbers come out and they're on the plus 8 side, the yens definitely are going to take off. Because they take off, especially let's say here the euro yen, you're not going to see this euro dollar right away, or your majors, Aussie and pound here. They're not going to, I wouldn't see them selling off as much. Now that's again if numbers come out positive. If numbers come out negative, negative 2 or worse, it's the opposite. We'll probably see then at that time the dollar sell off, and you'll notice the spreads, just as the numbers are getting ready to be released, they start widening, and we don't really want to trade while those spreads are wide. We want them to come back to normal before we actually execute. See 6 points, 4 points, 5 points? Look at that. So you already see the yen started to get bought, at least the dollar yen. And number, anyone has a number? I don't have a number here yet. Oh, 0.1. So we missed the 0.3. Core, we always want to look at the core number. Core is the number we want. And you can already see, the market responding to that. And the yens are getting bought and the dollar's getting sold, and you can see this tool here helps you to see into that mindset of these individuals that move these markets. Your interbank traders, your market makers, and then how to use that savviness of what they do based on the information you learn. What's taught in books, and then how do you take that information and turn it around on those who are using that information. And that's kind of what we're going to try to teach you in here, how to see that. And it happens over and over again. And a classic thing that happens, I'm sure most of you who are in here, your basic education is seeing breakouts, right? So whenever you see a breakout, here's a breakout, you're probably taught to go ahead and take the trade. And again, there are many indicators that you're waiting for to get confirmation. Some of you guys are going to wait for open and closing of a candle, and you're going to wait for your MACD, your RSI, your slow stochastic. I mean, you start getting into all these things, but they're all lagging indicators, and your market makers know this. And so many traders, what they'll do is, by the time those indicators give them signals, let's say you're really, really good, and you get a signal to get in here to take this entry. And there's nothing wrong with that. The issue is, how do you manage this after you get in it? And so let's say you're in here somewhere around, I don't know, let's say 33.07, 33.08. Let's say you got a really good signal and you took your entry. I mean, this is exceptional if you were able to get in here somewhere at big figure. Okay, so you had a breakout, you get in, you're long, and now you're thinking this thing's going to go to the moon. So your management skills tell you, well, set your limit up here somewhere, I don't know, 100 points away, and then set your stop somewhere. If you're conservative, you'll probably be taught to set your stop somewhere below the breakout in here. If you're really aggressive, you might set your stop out of this previous test of this range here. And if you're super aggressive, you might set your stop at, below the low of the day. There's a variation of stop losses here that go anywhere between 30 points to all the way down here to, I don't know, about 70, 80 points away. This is what every market maker out there understands. This is what the normal trader does. And so how do you recognize if they're dangling the carrot to get you to do this, to get you to go long, and then trap you in these positions? Now, the rookie trader, the one that missed this entry and missed this entry, you know, guess where their next entry is? And this is what happens to a lot of you guys who are learning this business. Man, I missed this move. Man, I missed this signal. All right, let me get in long up here. And this is where you're getting killed, because now you're sweating bullets. This trade is sitting somewhere in this area, and you're still holding on to this trade. You know, you might have set your stop somewhere down here below this area again, and now you're waiting for this thing to develop, to get back up here, you know. And you might sit with this trade all day. I don't know. You might hold on to it till Sunday, till Monday, till Tuesday, and then you pray. And you know, the market, maybe you get lucky and it does get back up here to this level. And then, you know, you might have had that limit up here of 100 points, but man, you see this thing just get back up to where you got in, and you know, you say, you know what, I'm going to get out. If I make, you know, 10, 15 points, I'm getting out. And sure enough, you get out. And so what used to be a 100-point limit now becomes, you know, maybe a 10-point limit, you know, I don't know, maybe less, maybe a little bit more. But again, it really starts affecting your mindset, okay? It really starts messing around with your mindset. And that's if that happens. The worst thing is that as we sit here today, this thing keeps dripping down, and eventually it works itself down to your stop loss, which is at this point, you know, maybe 40 points away. And you get stopped out. And man, that hurts. Because at 40, you know, losing 40 points hurts. And then it does eventually work itself here to this, you know, level where you have your stop, and then the market bounces and it takes off and it goes. And let's say the worst case scenario runs up and it hits your limit that you initially had, which was 100 points away. You know, at that point in time, you want to cut your veins, man. You know, right? It's like, holy moly. It's like, oh, man, I knew it. You know, I knew it. You know, what I needed to do was I needed to have my stop down here. I needed a bigger stop. So maybe the next time this happens again, you do it over, but this time you set a bigger stop. And as I've seen and I've explained in many of these things, the market eventually works its way back down here and stops you out there. So this time you take an 80-point, 70-point stop loss, and you take that hit. Your next question is, if the trade eventually does work itself out, you go back to same thing, same logic. Well, if it stopped me out here and it stopped me out here and then this thing took off, I just need a bigger stop. So your next stop is all the way down here. And as I've shown here many times, the market eventually does get down here, it takes you out. So next time you lose 100, 150 points, I mean, that's it, you've had it. So your next entry, if you do take one the next time, you set a bigger stop loss. I don't know, 200, 300 points. I mean, I've gone through this with many traders, and I've seen as much as 500, 600 point stop losses from traders who've gone through this, and they finally figured out that the way this, you know, to get away from this, to not get stopped out anymore, is to have a ridiculous amount of stop in there. What we're trying to teach you is in here is this is what market makers know. This is what they understand. This is why we're scalping the market. It's a lot easier to predict, you know, a quick, fast move. And as we've shown you with a consistency, you can build the account. It just takes time, but you can build the account, and over a long time, the consistency will add up. You know, it's the concept of taking a penny and doubling every day. You know, if you can do that consistently over the long run, it's going to, you know, become a lot of money for you. So stop trying to hit these home runs. They're tough to do. When they work, they're great. I mean, they really feed your ego, but they don't feed your bank account. In the long run, they really just suck up your bank account. You know, we're always trying to show you in here that it's better to be patient, wait for the retracements. They do happen. Take your chance, set a tight stop. If it doesn't work, so be it. Reevaluate, take another trade, and eventually, if it's not your second, it'll be your third, but eventually you will make those points back, and then you'll put some profit in the bank account. And then, you know, this is what this is all about. You know, preserve your capital. Preserve your capital. If you don't have capital, you don't have a business. You can't be, you know, you can't do this. And yeah, we should collect here.
It was a perfect example of what Armando was explaining earlier, how, you know, market makers will go stop hunting for the chasers. You know, the guys that are chasing these moves, they're pretty much killing them. You know, that's what Armando was talking about. You know, guys will be buying all the way up on the top of the moves there, like he was talking about earlier, and look what happens. You know, they go stop hunting. Guys, they pretty much killed any of the breakout traders that had their stop losses open here. And that's what they're doing. They're wiping them out right now before they potentially might, you know, bring it back the other way.